The briefing started, so slight delay this morning. Straight to it. Certainly most action seen so far in cable, so driven by sterling volatility. If we just check out this 5-minute chart, it's almost like we've had a full day session, already. Pretty steep sell-off that got underway around about 5 a.m. We were ticking up around 129.60 and broke lower. In the end, finding that a base at 129, and we've kind of launched off that, and this currency is doing its best to retrace the whole lot. We've almost just now another little stab back higher, and we're pretty much back to where we started. If we have a look on a 1 hour chart, you can see that all of this movement is just within the kind of range that we've had over the last couple of sessions anyway. It's not like we're breaking new ground on the upside or the downside here, but obviously quite a bit of, well, I don't want to call it noise, it's too big for noise of course, but quite a lot of just short-term volatility. And you know what, this is get used to it. Negotiations have started, and certainly, as I've keep saying, that the first portion of the negotiation process is not going to be friendly. It's going to be the opposite. You've got your two camps that are very much setting out their stalls with their demands, stubborn demands set out, and this is what's happening. What's gone on this morning, if we just flick to have a look at some of the headlines here. So this is in the FT. Brussels hoists gross Brexit bill to 100 billion euros. So we know that the first part of the negotiation process is going to be, as the EU put it, settling or agreeing on the divorce settlement, which has a few parts to it, but certainly top of that list is the exit bill. The other parts would be what's going to happen to EU nationals living in the UK. There's 3 million of them. What are their rights going to be? What's going to happen to the 1 million UK citizens living in the EU? We've then got the small but definitely not insignificant matters of physical borders between the Republic of Ireland and Northern Ireland and Gibraltar and Spain. These are the things that got to get sorted out straight up front. And the EU up until this point have been threatening a 60 billion euro bill. And here they're starting to throw around the 100 billion number. Even at 60 billion, there's no way the UK were going to be prepared to agree to that. Never mind 100 billion. There's a few technicalities in this, how they arrived at this figure. Actually, in the end, they're actually saying the bill will end up being 60 billion. But I'm afraid the UK, you've got to pay a much larger portion. You've got to pay a much larger bill up front, and then you'll get rebated as loans get repaid. There's a lot of, it's phenomenally complicated, but there's a lot of commitments that the EU feel the UK need to carry on contributing towards. This is long-term commitments that the EU agreed to. Long-term commitments on things like investment in Eastern Europe, for example. You've got loans out to the Ukraine, you've got loans to Portugal. There are a lot of commitments made, and there's a lot of admin bills to pay. And what's seen this rise to 100 billion, France and Poland have now piped up and said that we also want to add a portion for annual farm subsidies that the UK would have paid in the coming decades, but well, they're not going to pay it now, so who's going to pay it? So, well, let's get them to pay it up front. So this is kind of the talk that's coming out of the EU. Obviously, David Davis, the Brexit secretary here in the UK, has come out this morning and obviously said that we're not paying that. And this is a pretty big stumbling block right up front. I mean, it is worst case scenario. This first hurdle's too high. Negotiations break down, and we don't get anywhere. We don't even get off the starting block. And ultimately, you're getting some hard Brexiteers this morning coming out. This is on the UK side, and saying, look, if we leave with no deal, we don't have to pay anything. So it's not a surprise, and nobody should be surprised by this kind of talk at the start of negotiations. Check out. Let's go back to sterling, and this pretty much again, shouldn't be a surprise that you're getting, yes, sharp downside as these headlines start flying about, but what should not be surprising is you're then getting sharp swings back to the upside as this stuff retraces. Don't forget that this headline risk on Brexit is here to stay for years, and you get short-term trading opportunities off it. Emphasis very much on the short. Check out what's going to happen is people are then going to go back to the fundamentals, and look, don't forget the fundamentals. Check this data that we had yesterday. UK manufacturing PMI delivered at a 3-year high. So yeah, okay, Brexit's definitely key, it's definitely important, but you know how negotiations work. It's not going to start well. It hasn't started well. Expect more of the same for the foreseeable future over the next few weeks. And yes, you're going to get short-term reactions, but don't necessarily expect them to continue. If I go back to that cable chart, look at the daily. Don't forget, we are very high on a relative basis looking back over the last couple of months. And don't forget that the UK election is now, well, what's the date? It's 5 weeks. 5 weeks tomorrow, right? Am I right in saying that? It's 5 weeks tomorrow. Okay, so it's not far away, and if the Conservatives deliver a big majority, well then this is definitely sterling positive. So yes, you're going to get headlines from the negotiations, but don't forget about the election. Don't forget about underlying fundamental data. Don't expect one Brexit negotiation headline to trigger a collapse to 124. Okay, yes, short-term volatility, but you should be looking to get in and out of this stuff on a very quick time frame. So that's certainly got the session moving. If we go back to my other screenshot, we've had other news flow this morning, Brexit related, which is, again, a little bit more concerning and a bit more meaningful. JP Morgan to move hundreds of staff to 3 EU offices on Brexit. So I guess, to be honest, it's inevitable you're going to see some leakage of particularly US staff from the financial sector. I should say staff from US banks. Dublin, Frankfurt, Luxembourg. Paris not on this list, which will not please the French. But, this is the kind of headline that we are fearing, and it's the one that you should expect to be coming. It's still pretty vague. Hundreds of staff. I mean, how many hundreds? Obviously, JP Morgan have got thousands of employees in the UK, and so hundreds could be a tiny, insignificant number. But obviously, this kind of thing needs to be kept an eye on. The financial sector is particularly vulnerable to no deal, of course. So this has got the session up and running. What else is in the mix? Well, let's just check through some of the headlines. So here's a chart looking at Apple. Apple's share price last night dropped 2%, trading around about $148. This is when they delivered their earnings for Q1 of 2017, and then a sharp reversal to the downside. So on the face of it here, you would say, well, not good news. Well, let's check this out. They delivered 50.8 million units on their iPhone sales, and this was the problem. Despite beating on the earnings per share, I mean, their profits went up 10% in that quarter based on the relative quarter the year before. But it was the iPhone sales that dipped slightly, so they only sold 50.8 million units. A lot of this, well, according to Tim Cook, is being blamed on the fact that there were information was leaked about the next iPhone, because we're coming up for a new iPhone. Apple work off a 2-year rotation with their handsets, of course, and come October 2017 we should be getting iPhone 8, and the rumouring is that they're going to make some significant change-ups, and that what Tim Cook is suggesting here, that unfortunately they had some leaks of information on this, and this has persuaded some consumers to hold off on upgrading, wanting to wait for later in the year to get this new phone, this new handset. So this is what's to blame. That 2% sell-off, by the way, let's get it in perspective. They're going to be okay. Check out this chart of the last 12 months. So Apple dropped to 140. Sorry, let me just check. what was it, 145 basically, yeah, so 145. So this chart doesn't take into account that extension on after hours trading last night. So they're back down to 145, but as you can see, track back 12 months and they were trading 90 bucks. I mean, it's quite a phenomenal story. Obviously some of this is helped along by the fact that Trump's going to deliver hopefully deliver a one-off tax window for Apple to get its $200 billion of cash back home. What did happen yesterday, if I scroll down a bit more and have a look at some of these charts, this is their quarterly sales growth in inverted commas, because there was no growth. But if we flick down and have a look at the regions, this is where they did very well in the Americas and in Europe and Japan and indeed the rest of Asia. Nice strong sales growth, but China was where it kind of fell over. Now this was in line with their guidance, however. And overall their net revenue was 52.9 billion, which was 5% growth and slightly better than the expectations. The other thing they've done is they've announced, this is just their share price chart, I'll go back to that one looking at the last year. They've also announced that they are going to be upping their dividends, an extra 50 bill being put on the dividend, which makes returns Apple back to the top of the table of the single biggest dividend payer in the world. They've taken the lead back off ExxonMobil, so Apple now pay more dividends than anybody else on the planet. Being a tech stock, that's a pretty extraordinary sign of the times. Now, so Apple shares are done and dusted. It's always an event that the street looks for, obviously, in earnings season. Their guidance going forwards, another thing that dented the share price slightly last night, was they guided us to slightly lower revenues than expected, again citing the fact that people are going to be holding off on new handset purchases, waiting for this new handset to be delivered at the end of the year. Right, what else is going on? Fed watch. So it's the FOMC tonight. We'll have a look at the economic data calendar shortly. But the Fed are meeting. What we currently have is the idea that tonight's going to be a bit of a non-event. Tonight we will only get a statement delivered from the Fed at 7 p.m. This is they kind of have a rotation, so they have a meeting every 6 weeks. But it's only every other meeting that actually it's a 2-day process that leads to not only a statement being delivered, but also an update on their forecasts for GDP and inflation, plus then an update to the Fed's dot plot matrix, and then a Yellen press conference. That only happens every other meeting. So so the next time that's happening, where you get the full Monty, is June. Here we are in May. They only have a 1-day meeting, not a 2-day. They don't update any forecasts at all. They don't update their dot plot matrix, and they don't have a press conference. So all we get is a short statement delivered at 7 p.m. Because of the nature of this, it's definitely the case that the Fed are only ever going to hike on meetings where you get the full Monty. So they can justify their hike because of updated economic forecasts. They can communicate to markets and control and guide market reaction using forward guidance, i.e. their Fed dot plot matrix and Yellen's press conference. Okay, without those tools, they're not going to just make changes off the cuff here. So you're going to get very little, if any, change to the statement tonight. Current probabilities are 13% chance of a rate hike tonight. Probabilities of a rate hike in 6 weeks' time at their next meeting in June, 63.1. Okay, so tonight is not going to be particularly insightful, and is not really going to be a tradable event of any note, I wouldn't say. This is the inflation chart. Let me just make that a little bit bigger. Of course, Fed tracking inflation, and what also plays into what I've just said and why rate hike expectations for tonight are so low. I mean, they might as well be zero, to be honest. Inflation did take a slight dip in March, which kind of helps them to just keep their foot off the gas, gives them... also, we had that soft GDP print for Q1, of course, last week. So there are a couple of readings that will lead to the Fed to delivering a statement with little change, obviously no hike, and we move towards June when actually stuff might happen, and we've got time for this inflation picture to turn back higher, for example. Okay, so Fed tonight, but I don't think too many people are expecting anything. Other stuff, news on Greece. Greek optimism shines anew in a shift in bond yield curve. Look at this bond yield curve chart, and here we're looking at the 2-year and the 10-year. If you look up the top, and we've seen this invert back again. Well, sorry, it was inverted, I guess you should say. It's now not. So look at the 2-year. It's dropped back below the 10-year. Quite amazingly, the curve has been inverted right the way back to January, where you've got your 2-year yield higher than your 10-year. This is off the back of news flow, and this is the yield spread down here, showing that we've dipped below zero for the first time since January. This is just off the news that Greece have done a deal in principle with regards to, yet again, they've done a deal with regards to pushing through more fiscal adjustment targets, more pension cuts, for example, dropping the lower band for income tax and all this kind of stuff. They've agreed on it. It does need to now get voted through Parliament, and then this should then pave the way for Europe to pay Greece's 11 billion plus bill of redemption payments that are due in July. And we move forwards. The circus continues. The circus has been alive for 7 years. That's when Greece first had their bailout number 1. It is now quite remarkably 7 years ago. And you know what happened 7 years ago in May 2010? They agreed on a bailout program that was 2 years long, and they said that a 2-year program is more than sufficient. That'll give Greece plenty of time to sort things out. So we'll fund them till 2012, and then everything will be hunky-dory. Here we are 7 years on, and still the saga continues. But good news in the short term. Greek stocks through the roof off the back of this morning. The yield curve getting back to some form of normality where the short end's lower than the long end. All right, so that's the kind of news flow, the main stuff you're looking at on the headlines overnight. Let's just check in on the data calendar for today's session. We've just had some unemployment change numbers out of Germany that were bang in line with expectation when you're looking at the unemployment rate. So 5.8% unemployment as expected, same as last month. We got the unemployment change slightly better than expected, dropped 15,000 rather than the 12,000. This isn't significant news flow. Employment levels in Germany are the envy of the Eurozone. So looking at other stuff that's on the slate, we've got construction PMI at 9:30, European data at 10. So this will come in the shape of PPI, and then we'll get the first look at the Eurozone GDP as a whole. So we're expecting a growth rate of 1.7%. Okay, we've already had the regional numbers printed, so we've already had the giants of Germany and France and so on report their GDP, and so that of course makes this reading less significant, but we are expecting it to be, actually let me just get this on an annualized growth rate basis here. Here's the chart to get this in perspective. 1.7% would put it in line with the average we've seen over the last 12 months. So nothing really to get excited about. It's solid compared to, let's say, pre-2015 levels. 1.7% is very good, but in the grand scheme of things, it's still below average and below the numbers we were seeing back in 2015. So solid, but don't get too excited is the kind of takeaway. But as we've already had the underlying component countries report their GDPs already, this headline Eurozone number carries less surprises. We've got ADP employment this afternoon then. More importantly, we'll have ISM non-manufacturing and oil data. But on the ADP number, I mentioned this yesterday, we're expecting 175,000. I think people have lost confidence in this given what happened last month. This sometimes is used as that lead indicator. What's payroll's going to be on Friday? Because ADP employment is an employment growth measurement looking at the private sector only. The non-farm payrolls is the government official number tracking employment creation across both private and public sector. But this has been looked towards as a guide. You know, what are we going to get on Friday from payrolls? But last month, here's the chart. Let me show you. The ADP reading was a monster at 263,000. Let me just get that chart so I can show you. ADP came in at 263, printed at a multi-year high. Everyone got really excited. Wow, payrolls is going to be amazing. But when payrolls got announced 2 days later, it crashed to the worst reading we've seen in 12 months, and it crashed to 98,000. So the ADP number I don't think is going to get too much attention today, unless it comes wildly out of line with expectation. But it didn't give us any kind of guide at all. In fact, it gave us the wrong sort of view last time out. Bear that in mind. Don't expect too much market reaction to it this afternoon. What will be much more important, ISM non-manufacturing. This is coming at 3. This is like the US's version of services PMI. And we're expecting an uptick to 55.8 compared to 55.2 last time out. So that's definitely going to be the most important US data of the session. We've got oil inventories later. I'll show you the charts. We'll have a look at the charts to finish off the briefing shortly. Just for now, we're expecting a drawdown, 2.16 million drawdown on crude, builds on gasoline and distillates. But if you check out what was delivered by the API last night, they delivered a bigger drawdown on crude than those forecasts suggest that I just showed you, a drawdown of 3.6 million. Also significantly drawdown in Cushing, that's the third drawdown in a row, and significantly a gasoline drawdown. Remember that those estimates I was just showing you were indicating that you're going to get gasoline builds and distillate builds, but everything dropped last night. You got a full Monty of drawdowns. That's positive for price. When we switch and have just a quick look at the chart, let's do that now. I've got a couple of other graphics to show you, but this is a look at the chart. This is crude oil, and last night, I mean, we had a bad session yesterday, topped out, testing that high point from the previous session up at 49.30. That was around about midday. Then it was one-way traffic, some technical breaches. We broke to a new low at 4 p.m. and headed south, crashed down through $48, and in the end wounded up right down at 47.35. A full $2 move here. Quite amazing. And then you got the rebound off the back of those API numbers last night, and we're kind of in and around the kind of midpoint of that spike. So just putting this on a perspective, looking at the longer term, we were talking about this yesterday, how crude had edged lower, had broken the 27th of April low, and we were talking about the technical likelihood that we may well see this $47 area tested. Well, we pretty much did that yesterday. We didn't get to 47, which would have been nice and clean from a technical point of view. This quadruple bottom in March around about the 47 handle. We didn't quite get there. Depends on the inventory data this afternoon. If the inventory data this afternoon's bullish, this could well end up being the low point of the cycle here. You can see the cycle's very neat. We have a $7 range, $8 range here, 55 bucks to 47. We sold off through the whole lot of that in March. We then rebounded the whole lot of it pretty much. Now we've sold off the whole lot. If this cycle is to continue into June, when we're going to get the proper news, are OPEC going to extend production cuts or not? Well, then this needs to be, you've got to be looking at this as a kind of medium-term bottom around $47. We're going to need bullish inventory data this afternoon to cement that. It may be we get bearish inventory numbers, in which case, fine, we may well drop to actually test the $47 handle properly. But definitely $47, very important price for crude oil in the month of May, all right? Just quickly back to last couple of graphics before we look at the other charts to finish off. In fact, I've only got one more, because the other thing that's of note tonight, not only FOMC, which isn't going to be much, we've got the final TV debate, it's a televised debate. Le Pen squares off against Macron ahead of this weekend's second round and final round of the election. Based on an average of the 5 opinion polls in France, Macron still carrying a very punchy 20% lead. He's a shoo-in, surely. These live debates aren't going to change that. Le Pen in the press this morning, or headlines on Le Pen, seemingly backtracking away from her stance, or her very anti-Euro stance. She stepped down from being the leader of the National Front. She's seemingly now trying to distance herself away from being uber anti-Euro. Of course, this is a last desperate ditch effort to try and encourage some of those some of the electorate that normally vote for the more centrist parties. She wants to try and pull some of those in a last ditch effort to try and win this thing. It is last ditch, it is desperate, and it's almost certainly not going to work, but we're going to get the live debate tonight. So Frexit is off. The proportion of investors expecting a breakup of the euro area has dropped, and a lot of this is obviously as a result of the French political move towards the bang-in-the-middle centrist, very pro-Europe politician in Macron becoming president. Okay, let's just finish quick scan around the charts. Other than oil, which we've covered, and you know, we're tracking, as I said, in the middle of that spike higher from last night. Elsewhere, the DAX is just sliding. We've been trading on lows. We've gone down below 12,500. This was, let me just redraw, that was the top that we had back on the 27th. We've also got a high here that we're kind of breaking below, which was that high point that we had yesterday morning. So just on the slide here, European equities, you can see for the S&P technically a little bit more important around these areas. You've got this low point that we had yesterday. So yesterday's low, which held up things overnight, and S1 in here just preventing any more downside. If we do get more, then very quickly we hit the low that we had on the 1st of May, 2380. Before then, you're looking at this low point that we had back here at the end of April. So it's quiet this morning. I wouldn't say there's too much price action other than that cable movement off the Brexit headlines. Gold has been sliding, looking like it wants to have a little sneaky test of that low point that we had yesterday afternoon at 1250. Otherwise, euro dollar's quiet within yesterday's range. T-notes have been trading up around, ahead of the Fed. T-notes are on important levels from a resistance perspective. We hit this last night. These are these tops that we've been getting over the last few sessions, up around 125.25 area. You got R1 in the mix there today as well. Oh, sorry, that was yesterday's R1. Apologies. R1 today is a lot higher. No, it's not. Sorry, it's behind. Is that right? My chart looks a bit odd here. Weirdly, R1 is a lot higher above the pivot than S1 is below. But anyway, certainly the more important natural resistance levels are important and are to be aware of around 125.25. Right, that's it. All areas covered off. You should be prepped, ready to go. So that's the end of the briefing, guys. Enjoy the session. Thanks a lot.